Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll be bringing you essential updates and insights from the world of operational risk, drawn from the past week. All information shared here is sourced from the RiskSpotlight Portal, the premier forward-looking service dedicated to operational risk content. Let's get started. The first update is about the EU Pay Transparency Directive. The European Union is set to implement new pay transparency legislation aimed at addressing gender pay disparities. The EU Pay Transparency Directive, which must be adopted by member states by June 7, 2026, introduces several key measures. These include pay information disclosure requirements for job seekers, a ban on asking about salary history, the right for workers to request pay-level information, and mandatory pay gap reporting for companies with over 100 employees. Additionally, organizations with more than 250 employees must conduct joint pay assessments if there's a pay gap exceeding 5%. The directive also shifts the burden of proof to employers in pay discrimination cases and allows for collective redress. Statistics show that the gender pay gap in the EU stands at 13%, with 9 out of 10 companies paying men more than women. To prepare for these changes, companies are advised to conduct pay audits, review hiring practices, and establish clear compensation structures. The next update is on the historic Council of Europe Framework Convention on Artificial Intelligence and Human Rights. The European Commission has signed this framework, marking a significant milestone in global AI governance. The convention, aligned with the EU's AI Act, aims to set international standards for AI development while protecting fundamental rights. Alongside the EU, countries including Andorra, Georgia, Iceland, Norway, Moldova, San Marino, the UK, Israel, and the USA also signed the agreement. The convention addresses key areas such as transparency in AI-generated content, risk management, documentation for high-risk AI systems, and human rights protection. It introduces innovative concepts like regulatory sandboxes for safe AI experimentation and adopts a risk-based approach to AI oversight. The agreement allows flexibility for private actors while requiring full compliance from public authorities, with exemptions for research, development, and national security purposes. The next update is about increasing DDoS attacks. According to Stormwall's DDoS Attacks report, Distributed Denial of Service, DDoS, attacks globally increased by 102% in the first half of 2024 compared to the same period in 2023. The government sector was the most targeted, experiencing a 116% year-on-year increase and accounting for 29% of all DDoS incidents. Entertainment and financial services sectors followed, comprising 16% and 14% of attacks, respectively. France experienced an unprecedented attack during its March elections. The average botnet size grew from 5,000 devices in the first half of 2023 to 20,000 in the first half of 2024. The report also highlighted increases in carpet bombing attacks and multi-vector attacks targeting multiple layers of the OSI model simultaneously. Experts predict further increases in attacks during the second half of 2024, particularly as more countries hold elections. The next update is about the cryptocurrency fraud. The FBI's Cryptocurrency Fraud Report 2023 reveals that cryptocurrency was involved in 50% of all financial fraud losses in 2023, despite accounting for only 10% of complaints. Total losses from crypto-related fraud increased by 45% to $5.6 billion, with 69,468 complaints received. Investment scams were particularly prevalent, representing 71% of all crypto-related losses and amounting to $3.96 billion, a 53% increase from the previous year. The report highlights the challenges posed by cryptocurrency's decentralized nature and irreversible transactions, making it attractive to criminals. Call center frauds, including tech support and government impersonation scams, accounted for 10% of losses. The FBI notes that cryptocurrency's promotion as an investment vehicle and the fear of missing out have contributed to its exploitation by criminals targeting unsuspecting consumers and investors. The next update is about the FinCEN's anti-money laundering rule. The Financial Crimes Enforcement Network, FinCEN, has issued a final rule expanding the definition of financial institution under the Bank Secrecy Act to include registered investment advisors, RIAs, and exempt reporting advisors, ERAs, with certain exclusions. This rule, effective January 1, 2026, subjects these advisors to anti-money laundering and countering the financing of terrorism, AML-CFT requirements already applicable to banks and broker-dealers. The rule mandates the development of AML-CFT compliance programs, suspicious activity reporting, and adherence to other BSA provisions. It applies to advisors with their principal office in the United States, as well as to certain activities of foreign advisors related to U.S. persons or conducted within the U.S. The rule allows for delegation of some compliance aspects, but maintains full responsibility with the advisors. FinCEN will collaborate with the Securities and Exchange Commission, SEC, for compliance examinations. This regulation particularly impacts the private funds industry, requiring enhanced due diligence for higher-risk investors or transactions. The next update is about recent developments in the global Mpox situation. Morocco has reported its first Mpox case last week. The Africa Centers for Disease Control and Prevention, CDC, and WHO have launched a continental response plan, seeking more resources and cross-border surveillance to control the outbreak. Now, let me provide a quick update on key operational risk loss events that were reported in the media last week. The first update is about the fine on TD Bank. The bank has been ordered by the U.S. Consumer Financial Protection Bureau to pay $28 million for repeatedly sharing inaccurate, negative information about customers with credit reporting agencies. The bank provided errors about personal bankruptcies, credit card delinquencies, and potentially fraudulent accounts. TD took too long to correct mistakes and failed to investigate some consumer disputes due to resource allocation issues. The payout includes a $20 million civil fine and $7.76 million in restitution to affected customers. The next update is about a data breach. Electronic payment firm FinCEN has notified approximately 1.7 million customers about a data breach that occurred in June 2024. The breach exposed sensitive information, including names, addresses, and social security numbers. The company has advised affected customers to monitor their financial accounts and consider placing fraud alerts on their credit reports. FinCEN is also offering complimentary credit monitoring services to those impacted by the breach. The next update is about a class action lawsuit on Ally Financial. This major U.S. financial services company is facing a class action lawsuit following a cyber attack and data breach that occurred in February 2024. The breach affected approximately 11.5 million customers, exposing sensitive personal and financial information. The lawsuit alleges that Ally failed to implement adequate security measures to protect customer data and did not promptly notify affected individuals. Plaintiffs are seeking monetary damages and improved security practices from the company. This incident highlights the ongoing cybersecurity challenges faced by financial institutions and the potential legal and reputational consequences of data breaches. The next update is about the SEC penalizing companies for violating whistleblower protections. 7 public companies, including TransUnion and Acadia Healthcare Company, have agreed to pay a total of $3 million to settle charges from the SEC. Other companies involved include AKA Brands Holding Corporation, Appfolio, IDEX, LSB Industries, and Smart for Life, each facing various penalties. The SEC noted that these firms have taken steps to rectify the issues by amending problematic agreements. And there you have it, a whirlwind tour of last week's operational risk landscape. If you want to read more about the topics I have covered and review additional content on emerging operational risk topics, then please log in to the RiskSpotlight Portal if you're a subscriber, or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.